Good morning, all of you, and welcome to our second webinar organized by Zamara. Our regulators, esteemed clients, fellow service providers, panelists, ladies and gentlemen, we're happy to have you on board for this seminar to discuss the impact of COVID-19 on pensions and the changes in pension regulations amidst COVID-19. We'll be having another webinar on investments this Thursday, so please make sure to join us again at 10 a.m. same time. We have three panelists to help us with our discussions today. We have the CEO of Retirement Benefits Authority, Mr. Nzoma Mutuku. We have Sandeep Raichura, the Group CEO of Zamara. We have Margaret Wanjiru Kerima, who is a finance expert and also a pensions expert in South Africa. And we'll also have Anthony Kilavi sitting in to assist with any Q&A. As mentioned, we will be discussing, our topic of discussion today will be changes in pensions regulations amidst COVID-19. And to start us off, we'll be discussing three main topics. The first one will be on taxes and changes in taxation in this pandemic. As we all know, tax is a very emotive subject. And as I say, there are only two things in life that are certain, which is death and tax. As tax affects what we take home as pensioners and also as members of benefits, retirement benefit schemes, it's important that we pay close attention to those changes that either soften or tighten the tax regime. As an industry, and I want to say thank you very much to the industry and also the regulator, we will do the very best that we can to make sure that we lobby for friendlier tax changes that would otherwise be very difficult without the support of the regulator and also the industry. But before we go into this discussion, I want to welcome Sandeep to give us a few comments on the review on retirement benefit guidelines, retirement benefit schemes, following the impact of COVID-19. As we all know, Sandeep is a household name. He is the Group CEO of Zamara, a fellow of the Faculty of Institute of Actuaries, and he has a very distinguished career spanning over 2.5 decades, advising governments and key pension funds in various capacities in the region and in the continent. And Sandeep, we're very happy to have you here with us. Sandeep has been at the forefront of championing pension fund reform in Africa, and has written many articles, some of which you can read, you can find in our website and also on the internet. So Sandeep, I want to welcome you to speak to us. Please do share your screen so that the participants can follow. Just a few things at the bottom of your screen, participants. You have a few tabs. One of them is a Q&A tab and the chat tab. If you wish to raise a query, please click on the Q&A and you can raise any query. If you're addressing a specific speaker, please do mention that in your query as well. So Sandeep, welcome and over to you.
Hey, thank you very much, Matthew, and good morning, everybody. And a very warm welcome to our webinar today. I hope everybody is well and staying safe in this era of social distancing. And indeed, it's really good that at this time of physical distancing, we can still engage with each other using technology like this and participate in webinars and discussions. So this is really good. As a country and as a world, we're going through a very difficult time. Indeed, this COVID-19 crisis is probably one of the biggest tests for us as a country. First and foremost, COVID-19 is a health crisis. And sadly, more than 250,000 people have lost their lives in the world. We've had 30 fatalities in Kenya. The government has implemented various containment measures, and we believe that these containment measures, notwithstanding the increase in cases that we are seeing in the last few days, will hopefully succeed. It's still early days, but this should mean that we hopefully can not see the worst of the COVID-19 health crisis, and we will hopefully be spared the type of scenes that we saw in Europe, in Italy, Spain, the UK, and what we're seeing now in the US. But clearly COVID-19 is having a very severe economic impact. As a country, our growth rate that was initially projected at 6% for this year is now estimated at a baseline of 1%. And there are some suggestions that we could even contract as an economy. So these are very, very tough times for us as a country. The pensions industry has not been spared. Most pension fund investments have been impacted. Pension funds for the first quarter are sitting on negative returns. And the outlook for the rest of the year is also looking fairly difficult. As Matthew mentioned, we've already had a webinar on the impact on pension investments. We have another one on Thursday that will go into a lot more detail on different asset classes. But the purpose of our discussion today is to focus on some of the changes that have taken place in tax and some of the other things that will impact pension schemes in general. Okay, so it's really great for us to have Mr. Mutuku, the CEO of the RBA, with us, and Wanjiru from South Africa, who can give us a perspective on what's happening in Southern Africa. So what are we looking to cover today? We'll talk about some of the legal and tax changes, and I'll here talk about both those changes that have been implemented, including those that have been proposed. We're very conscious that a lot of the proposals that have been made have given rise to a lot of anxiety and concern amongst trustees and other industry players. I want to spend a couple of minutes allaying some of those concerns. Very importantly, the RBA has issued draft guidelines, draft regulations for the implementations of the changes that were made in the main Retirement Benefits Act to enable members to access a portion of their benefits to purchase a home. So we'll be talking about these regulations, what they entail. And Mr. Mutuku will spend a bit of time talking about the communiques that the RBA has issued to retirement benefit scheme sponsors as well as trustees. So the key piece of legislation that was enacted became effective on the 25th of April 2020 was a Tax Laws Amendment Act of 2020. I've listed on the slide, which you can all see, all the pieces of legislation that were changed, that were amended. And for our purposes, we will concentrate only on those aspects which impact retirement benefit schemes. So this is the Retirement Benefits Act, the Income Tax Act, the VAT Act, and the Tax Procedures Act. Okay, so in summary, what were the key changes in that act? So first and foremost, as I mentioned earlier, the main Retirement Benefits Act has been amended. The specific clause that has been amended is section 38(1)(a). As everybody will be aware, the legislation in Kenya has allowed members to be able to assign a portion of their retirement benefits to get a mortgage from a mortgage institution. And this has now been extended to enable members to actually use a portion of their retirement benefits to purchase a residential home. And we'll go into the detail in a few minutes. The rate of corporation tax has been reduced from 30 to 25%, and this impacts pension schemes. There's reduction benefits pension schemes in terms of the portion of contributions that are above the income tax limits. There's been an expansion on the PAYE personal tax bands. There's a reduction on tax on refunds of surpluses to employers, a reduction in VAT from 16 to 14%, and a reward for whistleblowing to the KRA of 500,000 shillings. Now, I also need to say that the original bill, when it was published, had some fairly draconian provisions which would have severely impacted the pension sector. Indeed, if some of those changes had gone through, they would have represented almost a fatal or a mortal blow to the pensions industry in Kenya. Because what the original tax amendment bill was proposing to do was to tax the investment income of retirement benefit schemes, as well as the NSSF, and to remove the tax exemption on pension benefits for Kenyans above the age of 65. As we all know that for the portion of contributions that are tax exempt, for as long as the pensions industry in Kenya has existed, we've had an exemption on investment income. And this is indeed one of the key advantages that pension saving in the country has over other means of saving. But if you remove this, it just puts pension schemes on the same level as other savings and would have been a very detrimental jolt. In fact, it would have killed long-term saving in Kenya. There was a very short exposure time given to stakeholders, and I'm really, really delighted that with the efforts that were made by Zamara as well as by other associations, these offending clauses were actually removed, and therefore, thankfully, the exemption on investment income for retirement funds, for NSSF, and for on the pension benefits of Kenyans above age 65 were retained. This, I really want to single out my colleague Anthony Kilavi, who really sprung into action very fast, engaged policymakers, including parliamentarians, and made sure that the Zamara proposal was actually looked at by members of parliament in the National Assembly, and these provisions were dropped, right? So this was it was an important accomplishment. Had this gone through, the pensions industry would have ended up paying almost 40 billion of tax to the government every year. But I think the battle is not quite yet over, because if those of you who have seen the finance bill of 2020, there is yet another attempt by government to remove the tax exempt status of pension funds. So this time, pension funds seem to be spared, but the NSSF, and the NSSF is a very important player in the pension sector in Kenya. So the new bill, the finance bill of 2020, is proposing to remove the tax exempt status for the NSSF. And very sadly, again, there is a proposal to remove the tax exemption for members above the age of 65, which they have enjoyed for the last few years. And some years back, as you know, there was a change again to the Income Tax Act, that those Kenyans who were earning the minimum wage, their bonuses, overtime, and retirement benefits were also exempted from tax. So it's really sad that at this time that the government is looking to bring in these measures. So there's a very urgent need for collaboration in the industry to make sure that these detrimental changes are removed, and also that the tax exemption status for NSSF, in which every Kenyan is a stakeholder, is retained. This brings me on to another matter in which there's been a lot of concern amongst trustees about proposals that have been made by various stakeholders to the National Treasury on how the pensions industry can be mobilized to tackle some of the economic and health implications of the COVID-19 crisis. And it's useful for me to give a little bit of background and context to this as well, so that everybody on this call understands the rationale. At the time when a lot of these proposals were being made, we were actually looking at a very deep health crisis in Kenya. The government's own projections were suggesting that we would have almost 10,000 COVID-19 cases in the month of April. And we were seeing all the horrific scenes that were going on, scenes from Europe and the US. There was a lot of concern that our health system was very fragile and would not be able to cope with a significant health crisis. And secondly, if many countries around us were implementing lockdowns, including Rwanda, Uganda, there was a feeling that even in Kenya, we would have to implement much stringent measures. And for all of these, the magnitude of the crisis was such that significant funding would be needed, and innovative sources of funding would be required. Now, coming against a backdrop where the government is proposing to tax the investment income of pension funds, that would have translated to a 40 billion rate on pension assets. There were proposals that were made, and these proposals were made recognizing that pension schemes are long-term entities. They have long-term liabilities that are payable over very many years into the future. Pension funds have a very visible and important stake in the health of the Kenyan economy. Already pension funds have taken a lot of sacrifice, and they could have more sacrifices if the economic outlook does not improve. And therefore, there were a raft of suggestions that were made for debate and discussion. And some of these included that pension funds of their own volition, offering a deferral or a rollover of their coupons on a portion of their government securities for a limited period of time. The issuance of a social impact bond. And the way a social impact bond would work is that there is a bond that is issued by the government of Kenya, in which all the institutions that participate in it, they take a haircut on the return, but in return for defined social outcomes, such as improving food and income security for Kenyans, improving the health infrastructure in the country, greatly increasing the PPEs and the testing kits for COVID-19, and also offering bridging loans to ensure that SMEs, MSMEs do not collapse. And very importantly, all these proposals provided for ring fencing of these amounts to be used only for defined purposes, for health, income and food security, and for an economic stimulus, and for independent monitoring by an external auditor, as well as penalties for breaches. And for all of these to be subject to the laws and regulations of the countries and the approval of trustees and fund managers. There was no compulsion intended. This is purely voluntary. And I'm hoping now that the government has been able to release the funding from the IMF, that the pandemic is not as severe in Kenya at this stage as was earlier envisaged, that some of these steps will not be necessary. But I think it's very important for me to say to trustees, do not be worried. Do not suddenly feel that their government is going to come and raid all the pension funds and the hard work that we've done over many, many years. I want to move on to talk about the tax changes that were implemented in the Income Tax Act. So firstly, there was a reduction in corporation tax from 30 to 25%. Now, this does benefit pension schemes in the sense that those contributions above the tax exempt limits, on which there is a tax, the corporation tax is payable, that tax is reduced from 30 to 25%. There is an increase in the annual personal tax relief from 16,896 to 28,800. And importantly, monthly income below 24,000 is now tax exempt. In terms of the benefits paid from pension schemes, again, I'm not a tax expert, and Kilavi on the call is very much better able to explain these, but there is an expansion of the individual tax bands. So from the previous amounts, these have been increased, and the top rate tax is no longer 30%, it is 25%. There's also been an expansion of the bans on withdrawals after 15 years and before 15 years, and those are listed on the slide. And I think more importantly, what I can show is the impact that this would have on individual members' tax. So if somebody is leaving a scheme with a benefit of 1 million shillings, in the previous regime, the amount of tax that the individual would have paid would have been 58,290. Post this amendment, the tax payable is 45,600, and hence there is a saving in the amount of benefit, that the net amount that the individual member receives of 12,690. If you look at somebody on a benefit of 3 million shillings, there is a reasonable saving of 121,000 shillings. And if anybody is lucky enough to have a pension pot of more than 10 million, which I hope that all Kenyans aspire to, then the saving could be of the order of almost 500,000 shillings. Okay, so this is a positive impact, both in terms of reduction in corporation tax and an expansion of the tax bands for pension funds. There's another change that has been made consistent with a reduction in corporation tax, which is that if any scheme obtains a refund of surplus, then the tax charge to the employer on that refund is reduced from 30 to 25%. Now, this is only going to have a very limited impact, because it will only impact those very few defined benefit schemes remaining, and those defined benefits and having very substantial surpluses, and there are not that many of those around. Okay. The reduction in VAT from 16 to 14% will be of benefit, because there will be a less tax payable on service provider fees, so there will be more money left in the schemes. And as Zamara, we continue to motivate the government to make pension schemes a completely tax-exempt environment, and ensuring that even service provider fees are completely exempt from VAT to benefit members of pension funds. I mentioned this earlier, that the KRA, the Kenya Revenue Authority Act, has been amended to reward those giving information on any tax breaches. And also there is now a legal basis for banks to be appointed and act as tax agents for the KRA. So that concludes the run through the tax changes that have been implemented. And let me now turn to the draft Retirement Benefits Mortgage Loans Amendment Regulations 2020. There's a lot of excitement about these regulations amongst members of retirement funds. And we'll run through these in a moment. So as I said earlier, there is an amendment made to the main act, which extends, which enables members of funds to be able to access a portion of their benefits to purchase a residential home. This is subject to regulations to be issued by the National Treasury. And the RBA has, in record time, I must say, and we must compliment the RBA for doing this, that very quickly the RBA has come out with these draft regulations for stakeholder consultation. We also need to ask that this facility for members to be able to use 60% of their benefits as collateral has been there for some years now. In fact, since 2009. But it has not been taken up yet. Why is the take-up been poor, and how can it be made better? And are there any other alternatives to direct drawouts from pension funds? So we feel that there are a number of key considerations here, and it's recognized. And indeed, it's important that Kenyans can be able to own their own homes. I mean, it is very important that all of us can have a roof over our heads. And if we can do that whilst we are saving through a pension scheme, that's all the better. Our government has a policy to encourage more home ownership, and indeed, affordable homes is part of the government's Big Four agenda. So what is hampering home ownership in Kenya? We believe that difficulty in accessing mortgages and the high mortgage rates are a key hindrance. And this is what this legislation that was first implemented in 2009 was intended to cure, to help. But the facility has not been well taken up. And when we ask, why are not more Kenyans using their 60% of their pension asset as collateral, the feedback that we get is that mortgage institutions are not lowering their rates. So the mortgage rates remain the same. And when we talk to mortgage providers, they say that they look at ability to pay rather than the additional security that seems to be available. So for them, when pricing the mortgage, they look at the ability to pay. For members of pension schemes, because the rates are high, it means that those mortgages, that facility is then not taken up. So it's very critical that as a country and as stakeholders in this industry, we look at how can we have a workable mechanism that enables members to purchase homes even while safeguarding their retirement savings. And to do this in a way that will strike the right balance between the desire for home ownership and not compromising one's retirement savings, as both of these are and must be important priorities. Ideally, one would have preferred that we should still pursue the option of utilizing pension funds to have members access, to have mortgages become more affordable, so that this can meet the twin objectives that I outlined, enabling home ownership, but ensuring that you do not raid into and compromise your future retirement savings. And some of the suggestions that have been made to reduce mortgage rates are the government has got the Kenya Mortgage Refinancing Company, which has received funding from various donor agencies. We feel that we urge the government to actively to ensure that those mortgages can be unlocked so that Kenyans can start having access to affordable mortgages. And the second suggestion was to enable members to use a portion of their pension asset to get a cash-backed loan from a financial institution on favorable terms. So the pension benefit is still retained within the scheme, but it is parked with a bank or an institution. So they will have a lower return on the portion that they've parked, but they can then get a mortgage at a very reduced rate. And we also suggest to the RBA that we have a facility within retirement benefit schemes now, or the legislation enables members to save for their post-retirement medical. And we feel that there is a need to allow members to specifically save for purchasing a residential home using their pension scheme. So in addition to saving for their retirement, in addition to saving for post-retirement medical, the scope of saving within a pension scheme should be extended to include home ownership. And we feel that this is something that even as we consider this regulation, the RBA, the government, and other stakeholders will take up, so that we can actively see members making contributions to their pension schemes for housing purposes as well. Now, when we look at the new legislation and the draft provisions that have been made, we must recognize that, look, this will give a huge impetus to increasing home ownership for those Kenyans who are members of pension schemes. And this would be a very, very big plus. It will also incentivize members of pension schemes to increase their savings so that they can have a bigger pot to be able to use to purchase a residential house. And if we can have pension schemes enable saving for housing and other things, we could see an increase in pensions coverage and saving in our country. And all of these would be very positive steps for our country. Okay? Because home ownership is important. If there's things that we can do to make it easier and better and more accessible, we should definitely look at it. Some of the concerns relating to these regulations are that if all of a sudden everybody comes to say, we want 40% of our pension asset to purchase a home, assuming those homes are available, then you could have a massive disruption to pension schemes, you could have a massive disruption to our capital markets, and this would be a big challenge. Many schemes would start facing liquidity challenges, especially those that have illiquid portfolios and substantial property holdings. And we could also have this could also impact the returns of pension funds, because at this time, then schemes are having to liquidate portfolios and adjust to market conditions, and also see an increase in administration costs. And clearly, we are then dealing a blow to one of the main reasons why pension schemes exist, and this is to deliver an adequate retirement to members of pension funds in their retirement. Having said that, however, we believe that there is merit in these proposals. What can initially look very draconian or penal on pension schemes, if there are proper structures, systems, and controls that are put in place, this could be a very, very positive step for our pensions industry and could actually help to spur saving in pension schemes. What are some of the provisions in these regulations that are still in draft? So first of all, a house is now properly defined as a residential home. So one cannot just go and purchase any home or any property or a piece of land. There is also restrictions on the institutions that are approved from which members can purchase a home. So this is institutions approved by the Ministry of Housing, or those that are licensed under the SACCO Act, under the Insurance Act, or schemes that have residential houses that are available for sale or that would be built for sale. The regulations permit a member to use up to 40% of the accrued benefit, plus their ABCs, up to a maximum of 7 million to purchase a home. And the amount can also be utilized for transaction costs and any taxes applicable on a home purchase. Critically, the purchase price should not exceed the market value for a home. This facility is only for pensioners. What is not clear is how would it apply to deferred pensioners, if at all. If one has an existing mortgage, one cannot offset it. And this is only a once-off option in a member's lifetime of employment. So you cannot say that I will do it today, then do it again, or I will move to another scheme and do it. It's only available once off. How would this be implemented? Every scheme will need to amend their rules. So the scheme rules need to be amended to permit this facility to be offered. And the scheme also needs to set out the minimum requirements that need to be met by members for them to be able to take advantage of this. And again, there appears to be some flexibility for trustees to be able to set their own criteria. Members need to make an application, and trustees would consider this application, determine if it complies with the Act and the rules of the scheme, verify that the bona fide institutions are being used, ensure that the terms of sale are properly documented, retain copies of every home purchase, and keep a record of all the transactions that have taken place. So there's a fair amount of administration burden that would be placed on trustees and their administrators and fund managers as well. And the application needs to either be approved within 60 days or disapproved, and the trustees need to give reasons for disapproval. Now, the regulations, as I said, have been issued for a stakeholder consultation. The deadline for stakeholder feedback is on Wednesday, which is actually tomorrow, the 13th of May. Mr. Mutuku is on the call, and we suggest that there be more time given. Having said that, many associations are submitting their proposals and recommendations to the government. The Pensions Working Party of the Actuarial Society of Kenya is also making its submission to the RBA tomorrow. Some of the things that so first of all, we're recognizing the motivations, the rationale for this regulation, for this legislation. We believe that if properly implemented, it would be good for the country, and therefore we need to see how do we ensure that it is implemented in the best possible way. Some of the suggestions that are being made is that there should be another limit, that the 40% should also be subject to it not exceeding member contributions, including AVCs. So this will encourage members to make more additional voluntary contributions. To protect pension schemes, there is a suggestion that the total amount of money that can be pulled out of a scheme over a period of time, maybe 1 or 2 years, should not exceed perhaps 10% of the total assets, so that you retain some stability. So schemes would have to come up with criteria, and this could include some first come, first served. There's a suggestion that given the objective to promote affordable homes, perhaps the amount should be reduced from 7 million to 3 million and then be increased every year. So there are some useful recommendations that are being made. There is also a suggestion that if somebody has an existing mortgage, it would actually be fair to enable that member to be able to see, can they use facility in the scheme to be able to reduce or even offset their mortgage. So we look forward to seeing the proposals and submissions that are made by stakeholders. There are many trustees, sponsors on this call, so if they have suggestions, we look forward to listening to them. Either you can make them during this call, or on you can send them through the chat or email us as well. Okay, Mr. Mutuku will be talking about the communique that the RBA has issued to the industry. So I will skip this. The one thing that we would mention in terms of, there are many schemes that are looking at suspending or reducing or discontinuing contributions. And we strongly endorse the communique from the RBA, which says that member consents should be required and that one needs to check contracts of employment and the rest. And it's also important that there be some demonstrable evidence of adverse impacts on employers, so people just don't start doing this, and there ought to be a time limit on suspension of contributions. Before I conclude, I just want to highlight some initiatives that Zamara is taking. So our IT system is fully enabled to organize trustee elections completely online, and we've already started doing this. We are holding virtual quarterly trustee meetings on Zoom and Teams, and these seem to be going very well. And so there's no stoppage of trustee business, and I'm really happy with that. I'm also very proud to say that as Zamara, we had 107 schemes that we administer with December year ends, and we filed all our financial statements by the deadline of 31st of March. So we did not need to take advantage of the extension that was offered by the RBA. And also want to confirm that the levies for all our schemes were also paid by the due date of the 30th of April. One thing that we encourage trustees who are participating in this webinar is for them and their members to enroll more on the member online portals that we offer, so that members, even during this time, they can have access to all information about their pension schemes at any time. So to conclude my presentation, as a country and Kenyans, we're going through a difficult time, a very testing time, as I said, but we must have faith in ourselves. We will overcome this crisis. Yes, it will be painful. There is sacrifice at personal level, scheme level, but we will emerge much stronger and be much, much better in the future. And as I say, with every cloud, there's a silver lining. So look at some of the beautiful scenes that we're seeing in this world. And I'm hoping that everybody is making some time to connect with their families and friends. So social distancing doesn't mean physical distancing. We can still continue to engage. So thank you all very much, and looking forward to a good Q&A session and getting your suggestions and comments as well. Back to you, Matthew. Thank you very much, all.
Thank you very much, Sandeep, for your presentation. And the call to action at the bottom, at the end of your presentation. At the bottom of your screen, there is a Q&A tab. If you could kindly click on it, there are a few questions addressed to you. And to the participants, I just want to, if you look at the bottom of your screens, there's a Q&A tab and you have a chat tab. If you have a query, kindly please put it in the Q&A so we can actually track it and make sure that we don't leave it out when we are answering. There are a few questions on taxation addressed to Kilavi, and Sandeep and Kilavi, you can assist with that. Also on the housing regulations. So Sandeep, thank you very much on your call to action. And like you said, I mean, there's quite a lot that we need to do. And we also request the regulator to fully support us, because I'm sure a lot of trustees participating have a lot to say about the housing regulations and would like to put in some submissions. So thank you very much, Sandeep. Next presenter is Mr. Nzomo Mutuku. Mr. Nzomo Mutuku needs no introduction. He is a CEO of the Retirement Benefits Authority. And the regulator, I'd like to say that the regulator is a very central being in the retirement benefit sector, and they've been responsible for providing oversight and regulatory control, including liaising and advising government on policy matters. And as you have seen Sandeep break down the regulations, that the draft regulations on housing that RBA issued, and we really thank you, Sandeep, for doing that. We want to welcome Mr. Mutuku, who will be talking more about and enlightening us about changes to the pension regulations implemented through his communique, through his office's communique to us. Mr. Mutuku will be happy to, if you could kindly share your screen so participants can follow your presentation. And just to remind participants, you can actually, even as he's presenting, send your questions through. If you're addressing a query to a specific participant, kindly put their name in the query. Over to you, Mr. Mutuku.
Thank you, and good morning, everyone. Let me start by thanking Zamara for inviting me to come and join this webinar, and also for the other webinars you have been hosting to inform your stakeholders about what's happening in these challenging times. Let me thank everybody who is participating. I can see we have quite some huge numbers. That's very good, very encouraging, and I can see a lot of familiar names. So hello to all of you, and thank you for joining. I hope you can see my presentation. I'm going to take you through quite quickly because some of the issues have already been tackled by Sandeep. I'll start by just telling you where we were before COVID came, how we were doing, and then how it has impacted on us. Then the main issue, which is the measures that we have taken and communicated to the industry. So as of December, you can see our asset base had reached around 1.3 trillion shillings. So it was growing nicely, moving very nicely. Membership was up. We had a number of schemes, diverse different types of schemes. And perhaps very importantly, our coverage was at 22% of the labor force. So remember back in May last year, we launched a new strategic plan, which was starting from July 1st. At that time, we were at 20% of labor force. We have a target to go to 30% by the end of the strategic plan for 5 years. And already within the first 6 months, we were able to get to 22%. So we are doing very well. We are right on course towards achieving this strategic objective. And the reason we were able to do this was because a number of stakeholders had launched schemes targeting the informal sector. And of course, Zamara is one of them, but also others, including NSSF and a number of other players. And they had gone out and targeted the informal sector, leveraging on technology, mainly mobile phone technology, and we had seen very good take-up of these new products just within those 6 months. And this was what was driving up the coverage number. Of course, with COVID, this has really slowed down. People now have a lot of challenges and concerns, so it's not exactly the ideal time to go out to encourage them to save for retirement. But as we'll see later, there could be a silver lining here that we could leverage on. So that is where we were. Just to mention in terms of investment, where these assets were, this 1.3 trillion. From the left-hand side, you can see those bars are showing you the percentage of total assets in different asset categories, starting from 2016 all the way up to 2019. So the first one is guaranteed funds. You can see it's generally been around 15% of total assets. It's the money that we have in the insurance companies. And this is where most of the smaller schemes are invested. And for cash, again, has been stable around 1% of assets. This is really just for immediate liquidity needs. Corporate bonds, this has been an unfortunate story. I think we have seen corporate bonds declining over time. We don't see new issues coming. Most of the issues, when they mature, issuers are moving to other forms of financing. And to make matters worse, we've even seen some bonds being redeemed early before maturity date. So, whereas 10 years ago, this was an exciting new investment which was growing very fast. And if you look at other economies, I'm sure when Wanjiru comes to speak, she'll tell you how in South Africa, the corporate bonds market is much bigger than the government bonds market. And we thought we were heading in that direction, but unfortunately, we are seeing a reversal. And that's why you're seeing it's now down to 1.4% of assets. Fixed deposits have generally been around 3%. It is steady. Government securities is where we are seeing increase. In 2016, we were at 38%. Now we are at 42% of total assets. So we have seen sort of movement towards government securities, which again is not what we expected. We expected to see more diversification into other asset classes. But I think the way the markets were towards the end of last year, we saw more movement in that direction. Real estate has been steady around 19%. Offshore has also been steady around 0.5% of total assets. And the equity is around 17%. Private equity has emerged and is coming up slowly. And now we're at 0.1% of assets. REITs has moved in the opposite direction. We are seeing less money going there. And when we have not seen new issues coming in that space. Then you have the others which have small amounts. So overall, our portfolio is quite well diversified. I think last week we were having a webinar with Zambia and Uganda, and if you look at their portfolios, or even Nigeria, their proportion in government securities is much, much higher than 70% and so on. So ours is more well diversified than most African countries and even other economies, but still there's need for movement into other asset classes as well. So that is where we were. So how has COVID impacted? Sandeep has mentioned some of these issues. We did see disruptions in a lot of activities, restriction in movement, increasing unemployment levels, supply chain challenges, production challenges, and of course, huge volatility in financial markets all over the world. The GDP projection for Kenya has been revised down. Perhaps I'm not as pessimistic as Sandeep, we'll talk of 1%, but maybe we should be at around 2%, but we shall see. And of course, we have seen a lot of losses from investors in the stock market. For us in the pension sector, we have been impacted in a number of ways. Our members have been directly and indirectly impacted. We did see some of the people who were positive, including some of them who passed away, Unfortunately, these were members of some of our schemes. I think we know those cases very well. They are well publicized. So we have lost members. We have members who are sick. We have members who have recovered. Thank God. We have members whose relatives are affected. So our members are directly impacted and as well indirectly impacted. Our employers have been impacted. The industries have really taken various shocks. We saw it starting in travel industry, the airlines, the travel agents. We saw it move to hospitality, hotels, restaurants. And now we have seen it even in other sectors. Interestingly, even sectors like hospitals, we have seen private hospitals having declined in business at this time. It seems people are not going for the normal medical procedures. They have started to put them off, and we have seen that. And a lot of these employers have been writing to us and telling us about these challenges. So we have received letters. We started getting them from hospitality, but then over time we have seen letters coming even from other sectors of the economy. Of course, education. Education is been on hold, and so on. So quite broad-based impact on employers. Of course, once that happens, this impacts on the pension contributions. Some cases we have outright retrenchments and people coming for their benefits out of the scheme. Other cases we have unpaid leave, which means there's no contribution going in. And of course, many employers requesting for suspension of contributions for a period of time. Another issue that we have seen, which has been mentioned, is investment losses. But it's not just the stock exchange. We have also seen real estate being impacted. We have seen pension schemes having challenge collecting rentals because the employers who are renting those buildings and so on are having challenges, or the tenants are having challenges. Offshore markets have also been negatively impacted, though we have seen some cushioning coming from the exchange rate depreciation that we have seen. And then, of course, we have seen challenges with compliance requirements, which is where we issued the communiques. So what did we say in these communiques? The first one, which we did very quickly before March 31st, because that was the deadline for submission of the financial statement, was to request the Cabinet Secretary National Treasury to gazette a waiver for a period of 60 days, which he did through legal notice number 44, so that anybody who submits after that deadline would not be penalized for a period of 60 days. So the 60 days will be ending at the end of May. So anybody who has not yet submitted their financial statements, we still have some time, but let's make sure we do it before end of May. We believe that was enough time for you to do it. And we're happy that many schemes, many administrators like Zamara and others submitted before March 31st, notwithstanding that they had an option of doing it later. We commend them for that good effort. As for levy, the date did not change. The date was still April 30th. But what we said is, if you have not yet finished the financial statement for 2019, you could use the 2018 financial statement. But from what I've seen, most schemes were able to pay the levy using the 2019 financial statement. We have a few cases, but in majority, they were able to do it using the 2019. We were happy with that. We're also happy that some of the other returns that were due in April, because we also get returns on contributions, on investments, and so on, were also submitted on time. We commend again the industry for being able to do that. And then on this very tricky issue of employers who are not able to remit contributions, we did give various guidance based on the different scenarios. So scenario one, we have some employees who are still working, but their salary has been reduced. In this case, the contributions still come on time, but they are less because since they are based on salary and the salary is less, what coming in is a low amount. But this is not very disruptive because once the payroll has been done using a lower salary, it's quite straightforward to calculate the new contribution and send. Of course, from the scheme perspective, it has implications on the amount of money that's coming in, the liquidity issues, and so on. But it has worked quite straightforwardly. Where one is on unpaid leave, this is where it's important also for employers to check their employment contracts and so on, because I know some lawyers say that in our legal framework, unpaid leave may not be something which is provided for, something which can be debated by lawyers. I know in the US and so on, they talk of furloughing and so on, but our legal framework is not there. Nevertheless, if one is on unpaid leave, employees are considered to be temporarily absent from work, and normally the trust deed and rules does provide for temporary absence from work. And therefore, the employer and employee contributions are suspended for this period. But normally, the trust deed gives a maximum period, so it's not indefinite. So again, it's important for trustees and employers to look at what the trust deed says. It could be 6 months, it could be 3 months, or whatever. So I don't breach that period. The other scenario which we have seen a number of applications, like I said, starting from hospitality, travel, and so on, but now even coming from other sectors, is where the employer wants to suspend contributions temporarily. Now, normally the trust deed would allow for this, but subject to a notice period. So here what we have allowed is for members to seek consensus of, employers seek consensus of members if they want to do this. And this can only be for a specified period, it cannot be indefinite. So you get consensus of your members that for 6 months we are suspending contributions due to these unique circumstances. Then you write to us, and then after the end of the period, you resume contributions. And if the period ends and you are not able to resume contributions, then you will be accruing liability to the scheme, what we call unremitted contributions, and you'd have to give an action plan as to how you shall come back to contributions. In some cases, employers may want to vary the contribution rates downwards, and again, this is normally provided for in the rules, but subject to a notice period. So you cannot just say from tomorrow we are reducing our rate from 10% to 5%. Normally, the notice period which has to be passed. Then, so you say after 3 months from now is when you are going to reduce the contribution. And similarly, there are those who want to discontinue contributions completely, and so either initiate winding up of the scheme or have the scheme continue as a closed fund. Again, this is normally subject to a notice period, but we have said that if members are agreeable, then the notice period can be waived. Otherwise, if you stop contributions, you write to us today and say that you're stopping contributions, then for this notice period, you will still be accruing a liability to the scheme. It will be treated as an unremitted contribution and a debt to the scheme. So the various scenarios, I think the scenario that we favor is really temporary suspension for those who are in those industries which are really impacted for a specified time, and then you come back to contributions. I think that is what I would recommend to most employers who are really impacted. Other than that, some of the other measures, we had the trustee development program of Kenya trainings which have been going on, but now we have suspended them because they do require physical interaction. And you have also deferred the requirement that if you're a new trustee, that you should do this within 6 months, because obviously now you can't. But we are working and with some support from some partners towards online TDPK. So not just because of COVID, it's something that actually been working on from before, but we now need to move faster on that so that this program can resume perhaps on online basis. So we shall keep you updated on that. We had a governance on good, a deadline on good governance, which we had issued, and which was actually having some deadlines. For the larger schemes, the deadline for implementation was June 30th this year. For smaller schemes, next year, June 30th. However, luckily that guideline does already have a provision for one to defer compliance. It is based on the principle of comply or explain. So one can explain why they are unable to comply, and one of the reasons for not being able to comply, of course, would be this COVID crisis. So schemes can just write to us and say that they're not able to comply in these areas for this particular reason. AGMs, schemes have been allowed to postpone AGMs and to reschedule their own meetings. But we are really urging schemes to use channels like the one we're using today to host their trustee meetings and even the AGMs. So Sandeep, I was happy to hear that you're having trustee meetings through online. We now urge you to move to the next level, which is having the AGMs through online platforms as well. And then also we had some trustees whose term was due to lapse, and they were supposed to have elections or nominations for new trustees. And we have asked them to write to us on a case-by-case basis, and we have received a number of them. And we have been able to respond to them as to how they should address the issue, depending on the circumstances and whether it's a member trustee, a sponsor trustee, first term, second term, so on. So we have been able to advise. We are there to guide, so please, schemes should not shy away from writing to us with other issues that may come up that perhaps we have not anticipated in these communiques. So let me not talk about tax because Sandeep did this very well, but just to confirm that indeed the finance bill is having some of the provisions which have been elected by the National Assembly, one of which is on pension for those above 65, taxation for NSSF is also there. And therefore, as an industry, we need to mobilize to lobby for this to be drawn again. It happened last time. I think it would be very unfortunate for example, for the NSSF case. I mentioned that NSSF is one of the schemes that has been targeting the informal sector. They have really made a lot of good progress in bringing on board informal sector since we launched that scheme. We went to Nakuru and we launched the scheme. A lot of fanfare, and we told the people that they can join and tax exempt and so on. So it's almost like we are betraying them if now tax is introduced after we have brought them on board. So I think we really need to lobby against that, and also for those above 65. I think those are vulnerable groups in this time of COVID. This is not really the time for us to be taxing them. And then on the mortgage, again, Sandeep covered this well, but I think there are some principles that we really need to emphasize. We are allowing access so that people can get houses, which is a good thing, because if you can get a house during working life, by the time you retire, you already have your house. It's something that we want to encourage because, as you know, housing is a big challenge for Kenyans. But at the same time, we need to balance between allowing members to get this house and compromising the objective of the scheme, which was to provide an income in retirement. So these regulations have to get this balance, and it's not easy. That is why you see there are limits. Somebody may ask, why do you have a limit of 40% and so on? We have to have limits so that we can strike this balance. We also have to have limits so that it's not something which is open to abuse. We also have to have limits so that we don't put so much burden on trustees to administer this. So one of the questions I've already seen is whether you can use this to buy a plot and then you build, and the answer is no. One, because the Act was very specific, it was to purchase a house, so regulations cannot contradict the Act. So the way the Act was amended was very specific already. But even notwithstanding that, I think purchasing a plot and building a house is one of the areas which could easily lead to either abuse or could give a lot of work to trustees to know whether a house is actually being built and so on. So it may prove to be an administrative nightmare. So the way the Act is, the way the regulations is, this is for purchase of a house which is already built. It's strictly for residential. So again, the Act is specific on that, so you can't use it for, to buy a shop or something. It has to be for a residential house, and it is really in line with government objective for people to obtain housing. It is also skewing towards affordable housing. So one may ask, why are those who have mortgages kind of being excluded? The people who have mortgages probably they were already at a higher income level, higher savings level, and so on, and already catered by what is within the financial system. But we have this group of people who have not been able to afford houses, either because mortgages are too expensive or the requirements are too onerous and so on. We want them to leverage on what they have saved in the scheme to get these houses. So it is skewing towards the lower end, the affordable housing side. It is also, and I think Sandeep raised this point, critical that this new provision allows people or encourages people to save more for return. We have seen ABCs, for example, is not something which people generally use. But now we are seeing an opportunity for you to put more money into your pension scheme and be able to use that money quickly to get a house. So it is really a good stimulus for you to put more in terms of saving in your scheme. I think those are some of the principles. Of course, what we should adjust drafts, and we really appreciate the comments. We have seen a lot of comments already coming in. The email address is there. You can send your comments. We have received requests for more time, and the reason why we may not be able to extend the time is because we are really targeting if this can be done during the budget speech. Normally during the budget speech in June, the CS normally tables in the House a lot of regulations, legal notices, and so on. We have seen the Finance Act is already out. So now what is remaining is the legal notices and the regulations and so on, which the CS is going to table. So we're already very much behind the time frames. That is why we thought we would try to move this maybe by the end of this month. We have it submitted to the CS because we know the budget speech is normally on the second Thursday of June, and see whether it can be incorporated there. So that is why we have this kind of a tight time frame. So I think that is what I would have. I just comment on what Sandeep said about proposals which had been made in terms of pension industry supporting the industry, supporting the country, supporting Kenyans. I think these were noble proposals. As an industry, we are stakeholders in the country. If the country is facing, major crisis, we are the ones who are going to lose. If our employers are closing, then our pension schemes are not going to get any contribution. If our members are sick and they can't get medical services because the medical system is overwhelmed, we are the ones who are going to lose. If the markets have collapsed and there's nowhere for us to invest, as a pension industry, we are the ones who are going to lose. So I think it's very noble of the industry to come up with proposals to support the country. But for us as a regulator, those proposals should be done in a manner which is not, losing. Members are not losing. That's why when you have a proposal like the one which was talking of deferring interest rates in a valuation neutral manner, I think this is something that we can all support, because it is basically deferring, but you're still getting back what you would have gotten. Rolling over of a principal is something that we do all the time, so there's nothing so straight about rolling over your interest into a new security. It's perfectly logical, and in fact, instead of getting the cash and you're not getting any income for a few days, it's just staying in the bank. If you roll over immediately into a new instrument, your interest, then your members are benefiting because they're getting interest from day one. So I think those were a number of proposals, but I think it's important for everybody to realize that these were voluntary proposals. There are those schemes which cannot participate in some of these proposals. Because, for example, I've given you examples of industries where they are losing members, their contributions are not coming. Such a scheme has liquidity constraints, and such a scheme needs its interest to be paid so that it can meet its liquidity needs. So that scheme would not participate. But there are those other schemes which, being long-term investors, are able to participate in this kind of initiatives. So I think we should not lose perspective. It's not something which is being forced, it's a voluntary proposal from the industry, and I think it's something that should be looked at positively. Finally, on the screen there, I've just put up some of the channels that you can use. We don't want our stakeholders taking undue risks coming to offices, so we've put in place a lot of channels that stakeholders can use if you want to contact us. You don't have to come there physically. Members who want to file complaints can do it. You have a portal, a portal. I've not mentioned you have a mobile phone app where you can download the app and get all these services, including these complaints, and so on. Our service providers don't have to send the returns to us physically. They use the online submission that we have in place for them. And we also try to give out our information through social media platforms. We are on all the platforms and through our website. So yes, our office is still open, but we are keeping just the skeleton stuff there. So we'll urge industry members to use these portals. So allow me to stop there. And once again, thank you, Zamara, and thank you all for inviting me and allowing me to join this session. So thank you.
Thank you very much, Mr. Mutuku. That was a very insightful presentation, and especially on clarifying some of the very gray areas on your communique. And it's rarely we get the regulator to actually clarify some of these things that would otherwise be left to the interpretation of the industry. So there are quite a few questions that have been raised on the housing issue and as well on the communique. I'm very glad that you have actually answered and attempted to answer some as you were making your presentation. So thank you very much. We have 35 questions, panelists Sandeep and Mutuku. I know you have tried to attempt to some as you're presenting. If you could kindly go to the Q&A tab, you could answer some that you can easily answer, and some will take through the Q&A session. So thank you very much, Mr. Mutuku, and we look forward to the Q&A session with you. Dear participants, Sandeep and Mr. Mutuku have done a great job taking us through changes in the pensions regulations in Kenya amidst COVID-19, delving through the housing regulations, and as well the communique from RBA, and clarifying some of the key things that our trustees have actually been asking us as your advisors. But we will not be finished if we assume that this COVID-19 has only affected the pensions regulation, the pension sector in Kenya. And it would be very good because we're a global village to get insights into what other pensions industries across the continent have been doing to deal with this pandemic. So allow me to invite Margaret Wanjiru Kirima, who's joining us from Johannesburg, South Africa. Wanjiru is a CEO of Women in Infrastructure and Energy, an impact investment holding company. She currently chairs the investment committee of Momentum Corporate Pension Funds as an independent trustee also of Funds at Work umbrella funds. So we have Wanjiru, who also as a finance expert and also as a trustee, speaking to us from South Africa on how the environment there and the regulatory environment is, and also how they're trying to deal with this issue. She's a founder of a South African pension fund industry initiative funded by the IFC that supports the industry and serves to guide pension funds on responsible investing. She's a true global citizen with over 2.5 decades of experience in the pensions industry and in the finance industry, having worked across the globe with various capacities and sitting on various boards. She has a very, very long and great bio, which we'll make sure to share that with you as we share her presentation. But now allow me to invite Wanjiru to take us through her presentation and what has been the response from the industry down in South Africa on this COVID-19. So welcome, Wanjiru, and please share. James, would you kindly put on Wanjiru's presentation so that she can take us through?
Thank you, Matthew, and Jumbo, and from Johannesburg, as Matthew has said. My name is Wanjiru Kirima, and although I sit in Johannesburg, I have very strong and deep roots to Kenya. I think the specific question that I was asked by the organization is to look at our reaction to COVID-19 in South Africa. But I think firstly, before I look at specific responses to the COVID-19 in South Africa, let me perhaps give the audience and the participants a general view oversight of South African pension industry, which is somewhat different from the Kenyan pension industry. So to start with, how big is our industry? The pension industry in South Africa is 7 trillion rand, which converted into Kenyan shillings in today's rate is 42 trillion Kenyan shillings. Of this, we have the largest pension fund in Africa as the largest pension fund in South Africa, which is the Government Employee Pension Fund, and they are 12 trillion Kenyan shillings. And then we have another 12 trillion Kenyan shillings, which are the corporate pension funds, either through umbrella or standalone or union or sector funds. And then we have another the other 3 trillion rand, which is individual retirement annuities. So in total, our pension scheme is somewhat different from South Africa, or from Kenya, in that it is just slightly bigger. The second big differentiator is our asset allocation model that we have in South Africa. So for the assets we would have between 50 to 60% of the average pension scheme being invested in equities, local South African equities. Then we'd have between 10 and 15% being invested in local bonds, local private equity, cash, so the bond sector of our economy, and then up to 30%, with the majority of pension funds being 30%, being invested in international equities. We then have a specific sector of the industry that does allow South African pension schemes to invest into the rest of the African continent, and that is up to 10%, but that has had a very low take-up, and we are looking at a maximum of 1% being invested within the African continent. I think that's the first thing. So we have a different size of asset, and we have a different asset allocation. So for example, if we look at the returns of our pension fund for 2020, the average pension fund between 1st of January and 30th of April has given a return of -5%. But if you strip out the offshore element of that, you will find a return of -11 or -12%, primarily because the rand is one of the most traded emerging market currencies in the world, and our rand to the dollar and our rand to the pound and our rand to the euro over this period has decreased by between 20 and 30%. So we've had a significant reduction in the rand dollar and rand euro and rand pound exchange. So those have been the important aspects. The other aspect around our pension industry is that with formal employment, all employers are by law, which is labor law, have to provide a pension to the employees, and they have to provide a risk benefit, be it death, funeral benefit, but they do have by labor law to provide those two fundamental benefits. So when we hit the COVID-19, we as an industry were very quick off the mark to say the following. The principles were the following. The first principle is that we would like to encourage none of the employers to make any retrenchments. So we put in place a number of measures to say, if you can't pay the employee either on the pension or salary, there are a number of initiatives that South Africa has to bridge the gap through the COVID-19 challenge that we have as a country. So what, in principle, what are the things that we have done as a country that says we are going to allow the employer to have a different model than many other countries? The first one is that the government has a very strong unemployment benefit model. So if you find yourself with the employer wanting not to pay you, you can claim unemployment benefit in South Africa. That's number one. Number two, if you're over 60 in South Africa, you will get an old age pension. Number three, if you have a challenge and you fall sick or something happens at the office, there is a compensation fund that you can go to. Number four, in South Africa, there is a child benefit that you can claim if you have children, and therefore you need to give them sustenance and food and pay school fees. Number five, if you are a low-income family, you will be able, and you have children at either school or university, the government does have schemes where you will get paid by the government to send your children to university. Number seven, through the COVID, the government has put in significant value propositions around supporting small and medium companies. And in addition to that, the government has put in the fact that if you cannot pay your mortgage or bond, the bank will allow you to have a 3-month gap. So I think this is to highlight the environment in which we find ourselves in South Africa as we came into the COVID. So this is the macro picture that I have presented before you, rather than specific risks and challenges that we have as a pension industry in terms of COVID. So I think I just want to go back to the first slide. So to say, this is what is the environment in which we find ourselves, and what happened once we hit the COVID. We as a country went into complete lockdown, level 5 lockdown, where we couldn't leave our houses. We had only the essential services working, and the country and the economy was literally put on lockdown. So what were the things that happened in terms of the pension industry? I think the first thing that happened in terms of the pension industry is that the regulator came out and said, we would like to put in models and systems in place that in principle will help employers not retrench people. And those I will give you going forward in the presentation, the 5 options that the regulator has given employers and employees around what to do if you have a challenge around, can you pay your employees and can you pay your risk benefits? The second big principle was that If you can afford to pay your risk benefits, please continue to pay your risk benefits at the same price before and after COVID hit your organization. So if you're going to get a pension reduction, if you're going to pay less in contributions, if you're going to reduce your pensionable salary, please do that if that's where you are as an organization, but please continue to pay your risk benefits in full. The third principle is please continue to pay your fund expenses, be it regulatory expenses, be it your service provider expenses, but please continue to pay those in full for as long as you can. So the three principles, if I can just summarize, was one, try not to retrench any employees, use the mechanisms that we have as a government and as a country to augment any income. Number two, please pay your risk benefits, because this is a health challenge that we have. So we don't want, through this short-term period, for people to fall sick, and then they don't have funeral benefits, and they don't have health benefits, and if they unfortunately pass on, then their risk benefit can go to the family. So those are the principles at which we started. So once we hit the wall of COVID-19, what were the things and the issues that the industry started to worry about? I think the first issue that the industry started to worry about was the massive fall in asset values that was coming through. South Africa has a huge defined contribution environment and a very small defined benefit environment. So we were facing a lot of asset value losses for when people were retiring or wanting to withdraw their assets from the pension fund. And the message that the whole industry was putting out was just take a deep breath and just allow, if it's a withdrawal, just don't try to lock in some of your losses. So we had, for the month of March, for example, the equity market in South Africa came down by more than 20% in 1 month. And people started panic withdrawing, and also those who were retiring started to want to buy annuities as soon as they could with a much lower market value. So that was the first aspect that we wanted to communicate to all the members in the industry. And I think the South African pension industry, the service provider, the regulator has done an amazing job in saying, let's wait to see what happens after the lockdown before you make significant investment or retirement decisions. The second one is there was a massive reduction in retirement income. So because of the reduction in value, a lot of the annuities and the living annuities that people can withdraw suddenly were a lot less. We in South Africa have a model where when you retire, you can take a pot of money and each year decide to utilize 10% or 5% of that money on your living expenses. And that pot of money was suddenly significantly reduced. The other aspect around retirement income was when organizations were putting in increases in retirement. A lot of previously we would have inflation increases in retirement, and now with COVID and with the drop in the market value of the pension assets, those increases have been reduced significantly. And then the other aspect is for the guaranteed funds, there was a big risk that the guaranteed funds would become underfunded, and therefore that meant there was risk from both the sponsor organization and the participants in these guaranteed funds, because suddenly where a guaranteed fund was 100% funded, it could potentially go down to 60, 70, or 80%. So again, the industry was coming out to say, let us wait for the lockdown to be finished. Let us find out what our new normal is before you make any rash decisions. So in summary, if the summary was, don't panic to members, let us wait to see, don't switch, don't withdraw, unless you have extraordinary circumstances where you have to do it now, wait for us to understand where our asset values are, what the impact will be and has been on COVID, and then make long-term decisions. So don't panic, don't panic, don't panic. So when we look at the returns over the last 4 months, we can now see that we are now moving into a place where the returns, although poor over 4 months, has been -6%. If you had looked at those same returns at the end of March, when we first went into lockdown, and South Africa, we went into lockdown on the 26th of March 2020, our returns were significantly poorer. We were looking at returns of -20% for some of the funds. So that was the first part about let's look at the assets and what we can do short-term versus long-term. The second challenge that we faced in this COVID-19 environment has been operational. We all are facing the same challenge of working from home. How do you keep up you've got reduction in connectivity and efficiency. You have the staff and the safety of your staff. You're having to suddenly move from paper organizations to digital, and how do you do that effectively and efficiently? And in addition to that, in this move and at times of uncertainty, we are seeing quite a lot of fraud. And if something happens, who is responsible of, if, for example, you now moving from a paper signature of a certificate to a digital certificate, how do we ensure we've done this and managed that risk? And then also governance and, having Zoom calls, having trustee meetings on Zoom, Teams, and all the other models of communication that we have. How are we doing that and keeping up on the governance model? So from my side, it has been business as usual in all the funds that I'm involved in. We've had all our trustee meetings. We have done all the governance. We have even done training on Zoom. We have quickly in South Africa moved to business as normal in a digital model. And then the one that a lot of people are finding a challenge in terms of operating from home is death benefits. Previously, the death benefits were a very hands-on. You had to go and meet the relatives had to come and see you. Some of the relatives didn't have technology, some of them did, etc., etc. So that, if we were to ask what has been the largest challenge around operating from home, it has been around death benefits. Next slide. So what were the options that the regulator provided to the pension scheme industry when we hit our lockdown on the 26th of March 2019? The first message that we kept giving to all the stakeholders that we were involved in is you do have an option to continue with no change to contribution rate. As in, don't take this opportunity to say we want to pay less to our employees because there is COVID taking place. If you can afford it, and if your business is collecting money and it's business as usual for your individual organization, please keep the contributions going through. So for example, banks that haven't seen a significant reduction in revenue are encouraged to continue paying contribution. Insurance companies, organizations that have accounting companies where they haven't seen a significant reduction in their revenue streams. Obviously, the sectors that have been affected are mining, hotel, and recreation. The organizations the small businesses where they did not have significant cash flow to sustain them over a long period of time. But if you can continue, the model is please continue to pay contributions, and specifically your risk benefits as well. The option 2, which we were given by the regulator, is to reduce pensionable salaries. So in South Africa, the pensionable salary is normally 60% of your full salary, and the regulator says if you want to reduce your pensionable salary, you can reduce it to 20%, to 10%, reduce it to what you can afford as an organization, because our principle is that we do not want you to retrench employees. And if we can help in any way by you reducing pensionable salaries, take that option. Again, please remember, as an organization, please continue to pay your risk benefits, your funeral benefits, and your death benefits at the previous salary rate. So they would rather, if you can't afford any pension, to go to option number 3, where you suspend contributions but keep paying the risk benefits. So option number 3 is the temporary suspension of contribution, where the employees are temporarily absent from work, and then you just stop paying all the contributions for the employer and the employee. Option number 4 is to reduce the retirement contributions, and that is for a period. And option number 5 is to defer your contributions and your risk benefits to a period later, but then you will have to pay all your previous contributions and your risk benefits. But again, if you can afford not to pay your risk pension contributions, please continue to pay. So some rules have changed in this model to allow you as an employer, if you can't pay any money into the pension scheme, to go and dip into your saved pot to pay your risk benefits. So you can't go and dip into your saved amount to pay anything else except your risk benefits. So again, we keep reiterating that your saved benefits are not cast in stone if it means that you cannot pay any risk benefits. Because the model is, if you can't pay your risk benefits and something happens to you, then that is significantly worse than if you are dipping into your retirement pot. The other interesting aspect around South Africa is a lot of the risk benefits that we have are 3 to 5 times your final salary per year, which means that your pension pot is significantly smaller than if something happened to you and you wanted to tap into your risk pot of money. So that is the ethos around where the industry is saying, at least let's keep the risk benefits continuing and at the previous salary that you had prior to COVID. Next slide, please. So this is the regulator came and gave us 5 options. But we have different stakeholders in the industry. We have the unions, we have employers, we have employees, and we have the pension fund trustees. So what is the employer responsibility during this time if they want to take up some of the options that reduces their cash flow burden? I think the first one is the regulator is saying you need to provide proof that you want to take up some of these options because of distress of COVID-19. You cannot, as an employer, just come and say we want to reduce our contributions without some sort of proof that you are not collecting as much money, or that your client base has reduced, or that your business has shut down. So if you are in the hospitality industry, it's very simple. We're in lockdown stage 5 and 4. So it's a simple one sentence: our shop is not opened, we are in distress. And then the second responsibility is keep paying your risk premiums. The third responsibility is full fund expenses to be paid where possible. So if it's not possible, you can go and start negotiating with some of your service providers, and some of the service providers, in fact, in South Africa, have gone into the industry and said, we are in this journey together. We will reduce our administration expenses by 20% through this COVID period. But once we're over the COVID period, we will revert back to our previous pricing. The other aspect that is the responsibility of the employer is communication to employees of changes. And this is quite a big debate in South Africa of how do you define communication to employees? Is it that you send out an SMS? Is it that you send out a letter on your webinar? Or does communication mean that you communicate as an employer or as a fund, and that you receive back communication from your employees to say, we have heard, we have received the communication, and we agree that, you know, the business has been shut down and that you will need to reduce the contributions that are coming in. And different organizations and different employees have taken it differently. Sorry, Matthew.
We only have about 4 minutes to close. Is it possible to just run through what is remaining? So
I think I think it really is. The last one is defining the lockdown, which is the period, and our period of lockdown where you can apply is lockdown, which is the lockdown as per the government, and then plus 3 months. In conclusion, there are two aspects around which we are looking at COVID-19. COVID-19 can be done through your rules, and like Kenya, there are a lot of pension funds where you can suspend contributions through a natural disaster process and period. And then there's the second model that the regulator has asked us to engage around, is when you're suspending, let's look into the future and look at how we can, you know, keep employees in employment for as long as possible. I think I can wrap it up now, Matthew.
All right, thank you very much, Wanjiru. I think from what I can see, there was quite a bit of, a lot of thought that went into the amendments and what the South African regulatory environment has done to just make it easier for pension funds and for also employers and employees to continue contributing and participating. I can see that we've had almost 56 or thereabout questions. 43 of them have been answered. We'll actually send an FAQ of the questions that have been asked today, and we have responded to them. And could I kindly ask each of the participants just to pick a question and just answer so we can be able to close at least in the next 5 minutes. For the participants, please, you can still send your queries to info@zamara.co.ke. If you have any query, we'll still send it to the participants and we'll add it to the list of the FAQs that we send out. I have seen quite a bit of some good tips and also some contributions, very good contributions that will also form part of our submission as Zamara to the regulator in terms of the housing fund queries. So starting with Sandeep, then Zomo, then Wanjiru, could you each just pick a question so that we can answer and then we can close this at least in the next 5 minutes.
So Matthew, I mean, I have responded to a lot of the questions and I'm not sure, is there any specific one that you feel I need to pick on? But I believe that most of the questions that were there that I could respond to, I have responded to them. There are very many questions, Mr. Mutukuzomo, on the housing fund draft regulations, and we have also, there are some good suggestions that have come up, and we have suggested that the individuals also send send their suggestions to the portal and the email that you indicated, Mr. Mutuku. This is housing@rba.go.ke. And other than that, Matthew, I'm also conscious of time, but I have responded to most of the questions that were on the chat, as well as on the Q&A.
Thank you very much, Sandeep. I see you and Mr. Mutuku have answered 43 questions, so that's very good. You've been quite busy. Mr. Mutuku and Wanjiru, any question you want to take on live?
Yes, thanks. I've also tried to answer a number of the questions. I've also seen some very good suggestions. Please formally submit this to us. And why it's important to formally submit is that, we normally take this to Parliament. Parliament has the final approval after it's gazetted. And it's always good when we're able to say that, take this from the industry, somebody suggested this and put it in and so on. So it's good to formally submit as much as we'll start thinking about them even just from what you have submitted. I think what I want to comment on is there's a very good point was raised that we seem to be asking so much of members. We want them to contribute for medical, for housing, for retirement, and so on. And it's become maybe a bit of a burden. And I think this is an important point. These are all competing needs, and we need to finance all these needs. If you look, for example, in Singapore, where they do all this through the scheme, the contribution rate is 23%. Like between the employer and the employee, they're contributing 23%. Some goes to medical, some goes to housing, and then the bulk goes towards pension. So realistically, if we want to do all these things, we also need to save more. There's no doubt about it. We are not saving enough to be able to finance everything through the pension scheme. That's why we don't want housing to come and compromise our critical objective of pension. And that's why I keep urging members, this is an opportunity for you to save more so that you can meet these competing needs. And just to give an example, in our own scheme in RBA, we have recently launched the post-retirement medical. And as an employer, we are contributing, but we also expect the employees to contribute. Now, luckily, that's why I was saying sometimes these things come with silver lining. Because of the reduction in the tax rate from 30 to 25%, a lot of our employees have seen a 5% increase in take-home pay. And very many of them have now moved a part of this into the post-retirement medical. So they are contributing this money which before they were not getting, and instead of taking it and consuming it, they have moved it into the post-retirement medical. So again, if you are an employee and you get this 5% reduction in tax, it could be an opportunity for you to put it as ABC into your scheme so that you can get the housing benefit. So I think on that note, that was really what I wanted to comment on, but I think I've tried to answer other questions, but we look forward to receiving more comments through the official address.
All right, thank you very much, Mr. Mutuku. Wanjiru, any parting shot?
Yes, thank you very much. First of all, thank you for the opportunity. I think I want to just put as a parting shot how successful in South Africa this housing model has been, where pension fund employees and have been able to use their pension fund to buy into housing. The big differentiator is we have always looked at this as a wholesale model, where you can go as a collective as a pension fund and go to banks and then bring down significantly the interest rate being paid by your members. And it has been particularly successful for the lower income, where the higher income members were already receiving very preferential rates from the banks. But then they looked at the housing scheme as bringing down the interest rates for the members, and that has proven to be exceptionally successful in South Africa. So, we're happy to share the points of success, but also to share some of the challenges, but it really has been a very successful model in South Africa. So I'd like to congratulate Mr. Mutuku on the initiative.
I think, Matthew, if I may just make a comment in response to Wanjiru, and I just want to say that as Zamara, we are in active discussion with a couple of leading banking institutions so that we can say to them, it's not just a scheme coming. Zamara is coming with its full 170,000 members to you. What rate, preferential rates will you be able to offer us, right? So there are some very advanced discussions that we're in, and we are really hoping that we can change the needle on these mortgage rates substantially, significantly, and benefit members of retirement funds.
All right, thank you very much, Sandeep, Mr. Mutuku and Wanjiru. I know you're quite busy, but thank you so much for your time and also for sharing with us a lot of these issues and clarifying a lot of these issues that trustees have had. We have answered quite a lot of the questions. Like I said, we'll send the FAQs later. So you can still reach us on our global email, info@zamara.co.ke, for any queries that you may have. We'll also be sharing the presentations, today's presentations with you. This webinar is also recorded, and you can actually go to our website to view it again if you so wish. Just to remind you, on Thursday, we do have another webinar, and this is investing in a new normal. I'll just try to share the screen shortly so that you can actually see what it's about. There we go. So please join us again on Thursday, 10 a.m. to 11:30, and then where we'll deep dive into investments, and you can see all the experts there. So thank you very much for participating, and thank you for your very insightful comments and your queries, and we look forward to seeing you again on Thursday at 10 to 11:30. Thank you very much, and do have a great day.